Welcome to week 6 of FABM 2. Our topic is analyzing financial statements. In this session, we will be reviewing the three kinds of financial statements, namely income statement, balance sheet, and cash flow statement. Companies use these financial statements to manage the operations of their business and also to provide reporting transparency to their stakeholders. All three statements are interconnected and create different views of a company's activities and performance. Balance sheet or SFP statement of financial position is a report of a company's financial worth in terms of book value. It is broken into three parts to include a company's assets, liabilities, and shareholders' equity. Let's talk about assets. In particular, short-term assets, such as cash and accounts receivable, can tell a lot about a company's operational efficiency. Liabilities include its expense arrangement and the debt capital it is paying off. Lastly, shareholders' equity includes details on equity capital investment and retained earnings from periodic net income. The balance sheet must balance with assets minus liabilities equaling shareholders' equity. The resulting shareholders' equity is considered a company's book value. This value is an important performance metric that increases or decreases with the financial activities of a company. Another important financial statement is called income statement or SCI, Statement of Comprehensive Income. It breaks down the revenue a company earns against the expenses involved in its business to provide a bottom line, net income profit, or loss. The income statement is broken into three parts, which help to analyze business efficiency at three different points. It begins with revenue and the direct costs associated with the revenue to identify gross profit. It then moves to operating profit, which subtracts indirect expenses such as marketing costs, general costs, and depreciation. Finally, it ends with net profit, which deducts interest and taxes. Basic analysis of the income statement usually involves the calculation of gross profit margin, operating profit margin, and net profit margin, which each divide profit by revenue. Profit margin helps to show where company costs are low or high at different points of the operations. The third important financial statement that we'll be talking about is called cash flow statement. It provides an overview of the company's cash flows from operating activities, investing activities, and financing activities. Net income is carried over to the cash flow statement where it is included as a top line item for operating activities, examples of which are cash received from the sale of goods and services, interest payments, salary and wages paid, payments to suppliers for inventory or goods needed for production, and income tax payments. Like its title, investing activities include cash flows involved with firm-wide investments. Some examples are purchase of fixed assets, cash flow negative; purchase of investments such as stocks or securities, cash flow negative; lending money, cash flow negative; sale of fixed assets, cash flow positive; sale of investment securities, cash flow positive; collection of loans and insurance proceeds, cash flow positive. Lastly, the financing activities section includes cash flow from both debt and equity financing. Examples: dividend payments, stock repurchases, bond offerings generating cash. The examples cited under cash flow statement are from www.investopedia.com. The bottom line of cash flow statement shows how much cash a company has available. Free cash flow and other valuation statements. Free cash flow statements arrive at a net present value by discounting the free cash flow a company is estimated to generate over time. Free cash flow is a measure of profitability that excludes the non-cash expenses of the income statement and includes spending on equipment and assets as well as changes in working capital from the balance sheet from www.investopedia.com. Free cash flow and other valuation statements. Private companies may keep a valuation statement as they progress toward potentially going public. Another important note, FCF or free cash flow is also helpful as the starting place for potential shareholders or lenders to evaluate how likely the company will be able to pay their expected dividends or interest. Source www.investopedia.com.